Okay, well, thank you so much, all of you, for being on the call here, and I hope we can add some value to your thoughts about how to think about investing during these times where there's so much volatility in the market. And sometimes it exists, and sometimes it disappears. So anyway, this is the perspective that I wrote back in the beginning of April, and hopefully all of you saw it. The review of the topics that I'm going to chat a little bit about, and here we go. And so it was quite a ride in January, as we, all's well that ends well is one way of thinking about the world, but for a while there it wasn't a very good world. Shanghai dropped 20%, 26% in January. Domestic equities 10%. Oil prices 32% by mid-January. It's amazing. And 10-year treasuries were dropping as well. There was a great deal of fear of a hard landing in China and of a global recession. But it definitely could have been a lot worse. By the end of the quarter, China ended up recovering. Oil prices not only recovered, they actually gained at the end of the quarter. Domestic equities largely recovered. But there are still global markets with double-digit losses over this pretty wildly volatile period. So the Federal Reserve meeting in March was very important. On the one hand, they had a very positive view, certainly nothing but a positive view of the American economy. They thought about, they were interested and concerned and noted job growth. Gains in underemployment rates, that's important, and wage growth is even in some ways as important. And we could arguably be saying we're at full employment. But the Fed did not raise rates, as you may remember. And the forecasts of all of the pundits and the prognosticators in Wall Street and other places, the forecasts of 4 hikes at the end of the year are down to 2 or 1 or who knows, okay? And what are the issues? Global risks. Global risks are considerations for the Federal Reserve governors. And there are lots of risks. The Eurozone is probably one of the most serious, okay? Mario Draghi, the European Central Bank president, announced a really aggressive set of stimulus policies, interest rate reductions with negative interest rates, $20 billion of additional Eurobond purchases monthly to the $60 billion that he already is purchasing, included limited numbers of corporate bonds, which is just fundamentally, I think, something to really be thoughtful about, because it has to do with the fact that there's no unified banking system in Europe. And there's something called the Targeted Long-Term Refinancing Operation, affectionately known as TLTRO, that actually pays banks to increase lending. So Draghi is really pulling up all the stops. Now, the trouble there is that in spite of all of his cleverness, and he is a very clever, brilliant man, actually, the problem is that there's a lack of unified banking system in Europe. Many countries still require serious structural reform. We all know from the news an immigration and terrorism crisis. There are many doubts, including with credible financial economists and economists, about the ultimate success of the ECB policies. He's doing something that's never been done before. In China, we are in the midst of an enormous transformation of an enormous economy from manufacturing to information-based. And that's a very serious issue. I mean, China is not only the second largest economy, but it's an enormous country. And they need to manage a large demographic, a wide economic disparity, and lots of political strife that's rising. Japan, let's look at another place where things aren't going terribly well. They've imposed a very aggressive fiscal and monetary growth policy, but there's still little evidence that it is working very well. And one has to look at the aging demographic in Japan and cultural rigidities for wondering whether these modern macroeconomic monetary policies work in Japan or not. And then our friends across the pond in the UK have a referendum June 23rd on whether they're going to leave the European Union. These are major uncertainties for the pound and for the growth of the economy. So things could be better. And then, of course, we have oil prices, which is in some ways not just a pure negative, but something of a positive too. But the most important part of this dramatic fall in prices has profound implications not only from a global economic perspective, but geopolitically as well. Because the Saudi government has imposed, because of its ability to do so up until now, a consensus equilibrium that has been disrupted. And so many major oil-producing countries, including perhaps even the Saudis, are experiencing maybe not substantial economic difficulties in the case of the Saudis, but experiencing economic issues as well. And, of course, in some other countries like Brazil, the economic difficulties and the political ferment is particularly serious. So with the U.S. and Iran as major new crude oil producers, plus a global slowdown in economic activity, any changes in the prices of oil from the $40 level is pretty unlikely as far as I can tell. I think a fairly narrow range is all we can expect. But on the other hand, there is good news here. Because it's good for purchasing power, and it definitely is very important for American consumers and the American economy. But it is disruptive for many economies and for many parts of an industry, of many industries, energy industries especially. So let's think a little bit about the future as best we can. China's uncertainty remains a major driver of economic growth in the world, and it has many economic and political challenges. Weakened trade, low industrial production, worker strife as well, all serious issues that any manager of the economy has to be taking a lot of attention to. From a capital market perspective, this issue of onshore-offshore investing disparity reflects something going on here in terms of how to manage capital markets. They have stock sale bans, they have crackdowns on insider trading, they have market manipulation, lots of corruption in the Chinese economy. So, bottom line, what's going to happen here? Well, there are many ways in which the Chinese governors can manage that economy. But I think the safest and the least politically sensitive one is to opt for a currency devaluation if they have to, and that's as the least worst alternative for them. I think one way of looking at the world right now is that we are basically in a macroeconomic disequilibrium globally. We have negative interest rates and currency management. Now that helps to spur consumer activity in bank lending, but it doesn't work if everybody does it. We have the U.S. Central Bank in a very different phase. It's going one direction and everybody else is going in the other direction. So we have a consequence of disparate central bank policies that remain an open issue. And these contradictory policies could result in a slowdown of the U.S. recovery on the one hand, or ineffective non-U.S. growth on the other hand. So we've got this disequilibrium out there that's very much a risk factor that everybody should want to be very, very diversified as well. The essential problem is structural reform. I think everybody agrees on that, okay? Structural reform is absolutely necessary for long-term efficient functioning in global capital markets. Well, we need our politicians, we need our managers to understand the economic tools and have the political will to implement them. But the political will to use fiscal policy as aggressively is missing in almost every country that we can look at. So in particular, the Eurozone Bank Policy Union remains the single most obvious limitation and one of the most serious sources of risk in global capital markets. But there are positive signs. It's all not negative. I mean, you don't get to be on Bloomberg or CNBC if you have a positive message, I suppose. So nobody pays too much attention to all of these things, perhaps, and it's certainly not going to frighten you. But there is a healing U.S. economy that is an ongoing process. Maybe you haven't noticed, but the Dow is near all-time highs. There is enhanced purchasing power for especially U.S. consumers. We are arguably at or near full employment. The VIX is less than 14%, a very nice objective measure of what's going on here in the U.S. economy. We have a very cautious but very proactive and thoughtful Fed. There's really no evidence of a loss of momentum and innovation. There's an enormous amount of money going into research in the American economy of all kinds, including medicine and other things. So one thing to keep in mind is bull marks do steadily climb a wall of worry. And so to some extent, the more worried people are, the more likely we should be a little positive about what's going on. One final thing I'd like to mention, I have a topical issue that may be important or useful or at least interesting to some of you. We pride ourselves in our research, and I think it's fair to say that New Frontier is one of the most innovative companies, especially for its size, but even without its size, in the investment community today. And one of the things that I have noticed is almost something of a sea change in our understanding of private equity research. So just to set up the problem, many consulting firms typically claim that private equity outperforms capital markets by 3 to 4%. That's a standard thing that somebody might say to you, and they will mention, of course, there are drawbacks in terms of fees, complexity, liquidity, transparency, but nevertheless, it's going to give you a boost over capital markets, and if there's a low return environment, 3 to 4% looks really pretty nice. What, of course, most people can't do is invest in private equity, so it's kind of an interesting thing, but it's usually something that people talk about at the institutional level, or certainly at the large company level. But recent research has been using private equity replication with public small-cap securities. And while this is not the only paper on the subject, I think it's one of the most interesting. Eric Safford at Harvard reports a passive portfolio of small, low EBITDA stocks with modest leverage and holds maturity accounting, also important now, produces a return distribution that's consistent with pre-fee aggregate price equity indexes without the 6% average fees and without fire sales events. That, I think, you might find really interesting and perhaps even really important. So anyway, we think it's an important thing for us to bring to your attention, and we have a reference, if you wish, about this subject here. And finally, just for you to keep up to date on what it is we do around here, I've been making a number of presentations of New Frontier's research on what we call, ironically, the fundamental law of mismanagement, and has to do with the critique of some of the orthodoxy associated with active equity investing in the investment community. And of course, this is joint work with Robert and with David Esch as well. And so I just finished giving a couple presentations, one in San Diego and one in New York. And now I'm going to be off to London and giving a fairly major presentation at the CFA Society in London, also here in Boston and in Toronto fairly shortly. So that ends my remarks. As always, we try to encourage you to buy a very important book that Robert and I wrote. So anyway, I'll leave it here for Neha to continue.